Welcome to the third episode of our MACD saga. So far, we've built a solid foundation. We understand its components, and we've mastered the classic crossover strategy. We've learned how to follow the trend. But what if I told you that the true power of the MACD lies not in following the trend, but in anticipating when it's about to die? Today, we are leveling up. We're leaving behind the tactics that 90% of traders know and entering the realm of the elite. We're going to talk about divergences. This is, for many professional analysts, the real treasure hidden inside the MACD. It's the ability to read between the lines, to hear the market's whisper when it warns you that something is about to change dramatically. Mastering divergences is like going from being a passenger on the market train to being the engineer who sees a warning signal on the tracks long before anyone else. Get ready, because what you're about to learn today could fundamentally change the way you look at charts. In a healthy, normal market, price and momentum go hand in hand. They're like two dancers moving in perfect sync. If the price rallies to new highs, we expect momentum, measured by our MACD, to also surge with strength. If the price falls to new lows, we expect bearish momentum to intensify as well. A divergence is, quite simply, when that synchrony breaks. It's when the two dancers start moving in opposite directions. The price does one thing, and the MACD indicator does another. This discrepancy is a giant red flag. It's telling us that the conviction behind the price move is fading. The outer appearance, the price, no longer matches the inner strength, the momentum. There are two main types of divergences, and we're going to analyze them with the detail they deserve: bullish divergence and bearish divergence. Imagine this scenario. An asset has been in a prolonged downtrend. Panic has set in, and the price keeps falling, making lower and lower lows. Most people are selling or are too scared to buy, but you, with your knowledge of the MACD, notice something that others don't see. Here's the first part of the equation. The price makes a lower low. This is key. On the surface, it looks like the bearish trend is strong and healthy. Pessimism is at its peak. And here's the magic. The second part of the equation. The MACD makes a higher low. Look at what's happening. The price has fallen into a new abyss, but the momentum indicator is telling us, hey, wait a minute. The force of this last drop was much weaker than the one before it. Even though the price collapsed, the selling impulse, the bear's conviction, is running out of steam. The sellers are running out of ammunition. This is a classic bullish divergence. It is one of the most powerful signals that the downtrend is losing its soul and that a market bottom could be very near. It's a warning that an upward reversal is highly probable. It doesn't tell you the exact moment to buy, but it tells you, get ready, look for a confirmation signal because the tide is about to turn. How do we trade this? A professional trader sees the bullish divergence as the setup. The actual entry signal is often the next bullish crossover of the MACD line above the signal line. The divergence gives you the context. It tells you that this crossover is special, that it has a high probability of success. You're buying not just because the lines crossed, but because they did so after the market whispered to you that the selling was exhausted. Now let's go to the opposite scenario: euphoria in the market. An asset has been rising for weeks or months. Every day seems to hit a new record. People are buying without hesitation, driven by FOMO, the fear of missing out. It looks like the party will never end. But again, you're watching. First part of the equation. The price makes a higher high. The euphoria is at its peak. The news headlines are positive. Everything looks perfect. Second part. The revelation. The MACD makes a lower high. This is the disconnect. The price has scaled a new summit, but the MACD is screaming at us. Warning, the oxygen is running out up here. The impulse that carried us to this new record is significantly weaker than the impulse of the previous peak. Buyers are still pushing, but they're doing it with less conviction, with less force. The uptrend is running out of fuel. This is a classic bearish divergence. It is an extremely powerful warning sign that a market top may be near and that a downward reversal is likely. It doesn't mean you should panic sell at that very instant, but it's a compelling reason to, at the very least, tighten your stop losses, protect your profits, or prepare to close your long position. The strategy here is similar. The bearish divergence puts you on high alert. The execution signal to sell or open a short position is often the next bearish crossover of the MACD line below its signal line. The divergence has given you a fundamental reason to trust that sell signal far more than any other. Now, a crucial warning. Divergences are powerful, but not infallible. They can give false signals, especially if they're not read in the proper context. A very strong trend can show multiple divergences before it finally turns. So when are they most reliable? They are especially potent after a prolonged and sustained trend move. If an asset has been rising or falling for a long time, a divergence is a much more significant sign of exhaustion. In a sideways market or a young trend, divergences carry less weight. Think of it like a rubber band. If you stretch the band just a little, nothing happens. But if you stretch it to its limit for a long time, any sign of weakness, the divergence, is a signal that it's about to snap. Furthermore, divergences are more reliable on higher time frames. A divergence on a daily or weekly chart carries infinitely more weight than one on a 5-minute chart, which could just be market noise. Today, we have opened a door that very few traders dare to walk through. We've learned to spot the discrepancies between price and momentum, the bullish divergence, which alerts us to a potential bottom, and the bearish divergence, which warns us of an impending top. You are no longer just a trend follower. You now have the ability to question a trend's health, to see its internal weakness before it becomes obvious to the crowd. This is, without a doubt, one of the most valuable skills in a technical analyst's arsenal. But can we take this even further? What if I told you there are ways to make these signals even more potent? What happens when we combine the MACD with other indicators, or when we analyze the histogram with a surgeon's precision? That, my friends, is exactly what we will do in our next video. We will explore the elite tactics, the killer combos, and the advanced strategies that professionals use to squeeze every last drop of information out of the MACD. If this lesson on divergences has blown your mind and you feel like your view of the market has just expanded, show us your support. A like on this video helps us out immensely. Subscribe if you haven't already and hit that bell so you don't miss the next episode on Elite Tactics. And now I want you to go to the comments and tell me, have you ever spotted a divergence on a chart, maybe without even knowing what it was? Share your discovery. We are Money Talks US. It's been a privilege to share this secret with you. I'll see you at the next level.